Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul. Welcome back, buddy.
Hey man, how you doing?
I am good. I'm very good. I've been spending pretty much the entire day doing presentations on this new death benefit exchange strategy. So John and I have been going back and forth. I think still got a couple more hours left. So he's on his own now because I got to record.
Right.
Yeah.
And you have to go to baseball.
And I got baseball, so we got to cut this off in half an hour and get to baseball. Yeah.
Right on.
What's going on in your world?
Well, so when we moved in here, April of 21, we decided we had to do a lot of rehab to this house. We did all the bathrooms, we did the kitchen countertop for the island, we did the AC, we did flooring in the basement, carpeting, paint. Anyway, so now we're doing the main flooring. So 1,000 square feet, give or take, of luxury vinyl plank is what we opted for.
Yeah.
We need the durability for the dog, and if we turn this into a rental after. But folks have done a wonderful job, super efficient. It would have taken me like years to do this. They're 2 days. So
Some things are just not worth doing yourself. That's for
no,
sure.
my dad's like, you're doing it yourself. I'm like, Dad, when do I have time to do that?
Right. So this leads me to a conversation I was having with one of my sons this morning while we were waiting for his bus to show up. I calculated like my hourly rate, right? Let's say that I said, hey, Bo, my hourly rate is $200. Paying somebody to mow the yard in the summertime, I'll pay him $50. So is that a smart idea? And he thought about it. And I said, well, so what can I save by mowing the yard myself? Well, $50. Okay. What do I lose by not working for that 1 hour? $200. Okay. So does it make sense to pay somebody $50 to mow the yard so I can work for another hour and make a net $150 on that?
Right.
Right. So it's all a trade.
Only if you're looking to like an excuse to drink beer in the sun or, whatever. But
yeah, some people like yard work like it's their zen place. Not me. I could care less. I just like it to look nice. Let somebody else do it.
Right. The end result.
Yeah. There you go.
That's
cool.
why I make Anthony do it.
Well, yeah. So Bo's funny. He's like, well, this summer, I'll remember
You
that.
could pay me $50.
He's like, I'm going to have to raise my rates this summer. Because last year I would pay the boys not $50.
No.
I'd pay him to mow. And he's like, I'm going to have to raise my rates. So
yeah,
he's catching
I pay Anthony $10. We have a postage stamp yard here, so
Yeah.
It's terrible. Anyway, what are we talking about today?
You got a question to start with, right?
We do. Yeah.
right.
Let's start with that. This comes in from Chris. So he emailed me. This is actually last night, I think, because he was trying to talk to his wife about it. And so the question is this: is it better for me or is it better in general to contribute the minimum into the 401k in order to get the match, or do I keep, let's say it's 5% match, right? Or do I keep the 5% under my own control and give up the match? What say you, Dave?
Okay.
I already gave him my answer.
Well, so we don't give investment advice on this podcast or in person. But I'll tell you what I did is I had a 401k for a little while. And this is kind of funny because I started my infinite banking policies in 2010 when I was in the military. I got out in 2014 and went to a job in corporate America where, of course, you get the 401k. So I signed up
automatic
for that.
enrollment.
It wasn't at that time. I think now it is. Right. So I signed up and I did that for about 6 months. And then, I started getting back in the books and being like, I've got this infinite banking policy, what am I doing here? And I ended up stopping my contribution, and they did give me a match. I think it was like 6% of a match, but I stopped the contribution and I wrote out a paper, and maybe we'll put the show notes in there on why I quit my 401k. So I think I published an article on LinkedIn. So we'll add the show
You did.
notes
I
for
remember.
that.
I was gonna.
Yeah.
Yep. I was gonna mention that.
And I just wrote that letter to myself. And there's probably 7 or 8 different, headings on like 7 or 8 different reasons. And then I elaborate on every one of them underneath. And as a reminder to when I ever started questioning, am I doing the right thing? I would just pull up that document and read it again. And it would reassure me that, yes, I made the right decision for me. So I think there's very few people that would tell you not to take the match. And I'm not telling you one way or another. I'm just telling you what I did. And I was happy I did. It worked out well for me.
Yeah. My part of my answer to him, excuse me, was, I'd rather control 100% of my money than 95% of it at age 59 and a half. Right. I'd rather have all, because if you look at opportunity cost, Dave, we have no idea what that 401k is going to earn. Right. So there's a strong chance if you're savvy, right, and people that do IBC are savvy, that you're not losing anything by giving up the match. But again, like Dave said, I'm not here to give advice. That's a question that only you and your personal situation can answer. But it is very enticing. Oh, I get they match my contribution, right? And it's very enticing, and we're programmed to take it. And it's in the military now, and government workers, they get a match, right?
Yep.
And now this automatic enrollment stuff, they can't wait to separate you from your money, right? So anyway, like you though, I quit my 401k or the TSP after getting into IBC. Haven't looked back, no regrets, but I don't get a match. But it wouldn't have mattered.
No, you don't. What I would say is how much of a taxable retirement account do you want? Because the 401k, as everybody should know who's participating in one, you get the tax break today and you defer. You don't get a tax savings. So people stop, the media, the way they market it, they say tax savings, just like they call the 529 plan a savings plan. It's not. That's an investment plan. Your 401k is not a tax savings. It's a tax deferment. You're kicking the can down the road and you're going to pay taxes on the harvest, not the seed, which is going to be a significantly greater portion or not, depending on how the market does. Right. A great book. So I had a client email me, I think this morning, and said, "Hey, great podcast on Monday. I started reading the book you guys talked about." So I'll just throw out another book recommendation, The Power of Zero by David McKnight. I think that's a really great book. Although I will say he uses IUL. We would not recommend IUL for this. I would recommend whole life insurance. But The Power of Zero is really great. He breaks everything down into 3 buckets, like a taxable bucket, a tax-free bucket, and there's 3 buckets.
I read the book from the recommendation we got a couple years back during our hunting trip, and I did pick that book up and read it. But yes, I don't. It's on the shelf, but I can't remember exactly
essentially
the buckets.
Yeah, he breaks down the math on if how much of your income is it okay to have as a taxable rate during your retirement? Because if you go above a certain amount, which is a very small amount of taxable income, taking that, then you're going to start getting taxed. Up to 80% of your Social Security will be taxed, and it moves you into another bracket. So anyway, pick that book up and just replace IUL in there with whole life when you read it, and it'll be a great read for you.
Only if you want guarantees.
Only if you want guarantees. Absolutely. So, well, speaking of books and 401ks and all that stuff, we were talking before we started recording here about this book right here called Heads I Win, Tails You Lose by Patrick Donohoe. And I read this a couple years ago. And, if you can get one gold nugget out of a book, then it was totally worth your time. And there's one in here that stuck with me, and I constantly refer back to it. And I call it, he might call it he calls it the hierarchy of wealth. I call it the wealth pyramid. So you remember what that is. So you want to describe kind of, what that, create a visual for people to see here while they're listening.
Yes, another great book that I really enjoyed, and I think I read that book in 2020 or maybe early 21. But it's fairly new book. All right, so the wealth pyramid. So if you could picture, the Great Pyramids in Egypt and how they're shaped, right? They get, thinner or narrower as you go to the top, right? So at the bottom is what Patrick calls his like tier 1 asset class, right? And Dave, for us, the tier 1 would be what?
It'd be dividend paying whole life insurance.
It'd be dividend paying whole life insurance, right? So that makes up the largest portion of the foundation of this pyramid is his tier 1 assets, or what the banks would call tier 1 capital. Banks that, they buy whole life insurance, they buy products from life insurance companies all the time to fund, to serve as tier 1 capital, fund other things. But anyway, why would you buy it? I don't know. But it serves as tier 1 capital, and that's where the majority of our wealth should reside. And in our case, it does.
Right. And the criteria for tier 1 capital, he defines this as really everything that whole life insurance is, guaranteed, liquid, a prudent return. So we're not chasing a high rate of return with that capital. You're getting a return, but it's guaranteed, and control. So at the base of that pyramid, there's 4 tiers, and going up, picture an arrow on the right and an arrow on the left. The arrow on the right says risk, and at the bottom is 0 risk. And at the top of that pyramid, as it goes up, is maximum risk.
Right.
And then on the left, picture an arrow going from the top down that says control. So at the bottom, you have maximum control, and at the top, you have 0 control. So risk and control act inverse of each other on this pyramid as you go up the pyramid. So, and Patrick, I don't have any recommendations on how much to put in there. Patrick says 15 to 20% of your earned income should go in this kind of capital. What Nelson recommends is fund, like all of your income should funnel through this before it's used, right? So that's a goal to attain at some point. But he says 15 to 20%. We say, actually 15 to 25% is a great place to start for putting your money in this tier 1 capital through dividend paying whole life insurance. So, and then you move up the pyramid. So what's tier 2?
Well, tier 2 would involve things that you have control, collateral, cash flow, and consistency. So think that, that brings to mind investing in my own business, or maybe a business of a friend, where they give me, I don't know, maybe they give me some equity in the business, or they give me some capital goods like equipment or something that serves this client, like a nice truck or a trailer or a dump truck, right? Which we've done. How about real estate? Cash flowing real estate would be a good example of this, right? I like cash flowing real estate. It's a great asset that I put a lot of money into. So stuff like that, passive income, some control, some collateral, and something hard backing it up. I think it's great.
Yeah, and I think that's where we put a significant amount of our cash value towards. So first, tier 1, grow that capital base, and then take loans against our cash value in our policies and put it towards tier 2. We're just working up the pyramid. And tier 2, I would really, that kind of sounds like all of the private lending that we do. Like you and I do private lending in general, where we control the terms, right? There's collateral backing it. We get cash flow, and we like monthly cash flow, but we'll take annual sometimes too. And it's consistent. So every single month, same day that money hits my account. So that's private lending.
Yes.
Right there. Yeah.
Yeah, absolutely. And of course, we've talked about this in the podcast, Dave, before. We've evolved as far as criteria for private loans, and strategies for private loans and what we're willing to do with our capital now, vice, let's say 5 years ago, right?
Yeah, absolutely. 5 years ago, we were doing tier 4. Tier 4 was our base, not tier 1.
Yeah.
Right.
Right. Yeah. It was just not good.
Yeah.
All right.
All right.
So
what's tier 3?
tier 3. Okay. This is going to be familiar for most Americans, I think, Dave, right? Anyone that's in a 401k, anyone contributing to a traditional Roth IRA that's serviced by a custodian that is not a self-directed custodian, let's say, like a normal brokerage or something. So we have no guarantees, limited collateral, no control, and I'm reading right from the book. Or control is relinquished to a professional. So think your certified financial planner, your financial advisor, somebody like that you've got your IRA with that person's company as the custodian, and you are handing over a yearly contribution. Let's say if it's a Roth, or maybe you're doing a monthly contribution, you have a brokerage over there, you have 529 college savings plans and all these other things, right? That is what Patrick Donohue is talking about in this tier 3.
Yeah, and a lot of listeners are probably very familiar with maybe syndicating. So syndications could be tier 3 as well, where you're handing your money over to a professional. And a lot of these syndicators are great. I mean, you've worked with them quite a bit more than I have, and you've gotten your money back. You've gotten a good return, but there's still a significant amount of risk in that compared to tier 1 and tier 2. So
no
you
question.
move up the pyramid, you don't have any control over the terms. The syndicator is going to dictate the terms, and then you're going to lose control over your money for a set period of time, right? A term on that note. So your control goes down and your risk goes up. But it's kind of that, high risk, high return tier. So
yeah, and I might have jumped the gun on tier 3, Dave, but I think we got it. I think we got it right. To me, what he's describing is that, of course, is syndications, because he says it. But lending against collateral, okay, I agree. I agree with that, but I think if you take collateral properly,
you could move that to tier 2.
I kind of feel like it's like maybe two and change.
Yeah, right. Well, I mean, it depends. Hard money lending. I did hard money lending on the lendee side while I was flipping houses.
Yeah,
and those are pretty risky for the lender. They can be, especially if the economy takes a turn. If I don't perform, my contractor doesn't perform, the flip takes months and months longer than planned, and the economy turns and the house is underwater.
And they're in second position probably.
Right. They're in second position. They're not going to get their money back. They can come after me, but at that point I probably wouldn't have any money anyway, because it all went into the house. And so it's a lot riskier, which is why some hard money lenders can charge 20% and people take that money. 20% and 2 or 3 points on top of it.
And points. Yeah, they do points as well. Sure.
Yeah.
No, it's
so, and they take the points out when they loan you the money.
So it's up front.
Yeah, here's $100,000. It's going to cost you 3 points. We're going to keep that 3,000.
Yep, and give you 97.
Loan you 97. So you pay those points up front. Yeah,
that's right.
So good. Hey, he who has the gold makes the rules.
That's right.
Yeah. And then there's tier 4. So at the very top of that pyramid, where you have zero control and maximum risk, what would that be?
So I think it's more like what I was describing, although I think there's some overlap. So this might be, I mean, people are familiar with syndication and other things like that, but this is, I think, your traditional, where most Americans, what most middle-class Americans are doing, even top 10% earners are doing with their money. They're putting it with somebody, and they have no guarantees, no collateral. It's speculative. It's the stock market.
Right. It's, that great roulette wheel, the stock market. Yep. And where you get to take 100% of the risk, and you only get maybe 30% of the reward.
Oh, gosh.
After everybody else gets their share.
Yeah.
Right.
Oh, yeah. You're last in line to get paid. That's for sure.
You're last in line. There's like 6 people ahead of you that get paid before you do.
Hell,
So
even those banks that failed in '08, tho- those executives were still getting multi-million-dollar bonuses and stuff.
yeah,
Like what a
yeah,
what a great business.
I know, right? Great job destroying the company. Here's your golden parachute.
Golly.
So
Yep.
I would put other things in tier four, like cryptocurrency.
Oh my
Extremely
goodness, that's like tier.
speculative.
That's like off. It's like jumping off the pyramid.
I mean, it's so if you guys, can't tell, we're probably not too keen on crypto. And for me, it's because I like the idea. I love the idea of of DeFi and peer to peer
Yes,
transactions. What I don't trust is something that has no intrinsic value, and that there's really no underlying value other than what people think it is. Another thing would be like NFTs, right? Non-fungible token. Isn't that what it's called? It's like, how many people can actually explain an NFT and then they invest in it? Like that right there is, don't invest in anything you don't understand.
that's. I was going to say, invest in what you know, folks. I'm not comfortable doing those things. I also, Dave, don't have the time or frankly the desire to investigate it any deeper than we just did right now in the last 30 seconds.
Yeah, right.
So if you're a
Because
big crypto person, we're not your guys probably. I just
no, and there may be some people who there are some people again who are going to do a lot better in crypto than others because they spend the time and they reduce the risk of those transactions because they increase their knowledge. So as knowledge goes up, risk goes down.
right. And I'm not disparaging anybody that people are good at certain things. That's just not my cup of tea.
No, me neither. I heard a quote from somebody I really like, and he said the reason he doesn't like it is he'd rather get rich for certain than try to get rich fast or try to get rich quick.
Yeah,
Right?
I like that. And I told someone the other day, I'll take a steady 8 to 12% year after year all day over,
Yeah.
500% overnight. I mean, I really would.
Yeah, exactly. So that's it. So you got this pyramid, tier one, most control, least amount of risk on the bottom, all the way up to tier four, least control, most amount of risk. And that's really how you should build that foundation. But what do most Americans do? And certainly the middle class, they take that pyramid and they turn it upside down and stand it on its head. And
Well,
they
because
start
I was inverted,
tier four. Yeah. Inverted. So they start at tier four and funnel, 90% of their wealth building, maybe not 90, because a lot of the wealth in America is in people's homes. So
Sure.
call it 50-50. 50% of their wealth and their income that they put away for that retirement or a rainy day or whatever goes into tier four, where they have zero control and maximum risk.
I mean, you just described, me for most of my military career, right? I started off at the top of the pyramid, or, it was inverted, so I was still at the bottom, but I was putting every extra penny I could frankly into the stock market through
Right.
through my least favorite product now, mutual funds.
Yeah.
But at the time I had no knowledge. I didn't really have the time to, or maybe I did, I just didn't, right? But yeah, totally inverted.
Yep. And because that's what everybody else is doing. And I mean, if there's
Yeah.
one organization that teaches you to be a conformist, it's the military. So just stand in line, march, look like everybody else, do what everybody else does, and don't get on anybody's radar. Right? That's like ingrained to you in you when you get in the military.
At the right place, right time, right uniform, and gosh, you'll make lieutenant colonel.
Yeah, stay out of trouble. So it's very easy to follow the crowd in that sense. It's very difficult to take that pyramid and turn it right side up and start where you should start. I thought it was funny. I remember having conversations with people when I was first starting out in this business and I hadn't honed how I explain it and how I relate to people with this concept. Sure. So I would just come out and talk about it. And, because whole life insurance is such a foreign concept to the majority of people and a frowned upon product to much of the mainstream financial advice, I would get people saying, yeah, well, I do, 401k and everything. And yeah, I don't think I'm really interested in whole life insurance. I'm very conservative. And I would say, well, obviously I missed the boat on explaining this to you, because there's nothing more conservative than guaranteed whole life insurance. Right.
Right. I mean, you probably did a fine job. I think it's just people are programmed and brainwashed to see things a certain way. And like I said in other episodes, their understanding of whole life insurance is based off somebody else's misunderstanding of it, right?
Yeah,
and
absolutely.
That is the case. And that, thankfully, we got a recent client that comes from a family that buys whole life insurance and has for generations.
Cool.
And gosh, that's great.
Yeah.
That doesn't happen. That's the first time I've encountered this.
Yeah. I think going back to that, the statement that this one person told me, oh, I'm conservative, so I don't do life insurance. It makes me think some people confuse being conservative with doing what everybody else does, like as if they're the same thing. I'm conservative,
Right.
so I just stick with the mainstream avenues, right? And that's
Right.
completely opposite of being conservative. There's
Yeah,
nothing
conservative would be like,
go ahead.
yeah, like warehousing cash under your mattress or in a fireproof gun safe that's good to 1800 degrees Fahrenheit or something for an hour, right? And then the next step would be doing that, but keeping it in the bank, a good bank or a credit union or something.
Credit union, yeah.
And then the next probably thing is whole life insurance. It's boring. It's slow. It's not sexy. Oh gosh, it has guarantees. Oh, it doesn't involve the IRS. Oh, I don't want that. I would like something that generates a 1099 of some sort, because I want to pay more tax.
I can't I just want to do my patriotic duty. So if you could put your money somewhere where it was guaranteed, where you transferred 100% of the risk of loss to another company, where you earn consistent return, where it's liquid, where you can leverage it, where you get to earn uninterrupted compound growth and tax-free growth at least access it tax-free upon the growth. Does that sound like something you'd be interested in?
That sounds like what you evolved to.
Everybody would say, yes, that sounds amazing. And then you say whole life insurance and they're like, oh, okay, you got me there. You try to pull a slick one on me. So call a spade a spade. Like, that's exactly what whole life insurance is. It's guarantees, it's liquidity, it's risk transfer, it's compounded growth, uninterrupted compound growth. You can't get that anywhere else that I know of.
No. And what a way to live, Dave, by buying that product and then overlaying, matching it up with IBC, right? Gosh, all this money that we've poured into this house, back in my old life, Dave, I think I would have either not done it and just lived with the way the house was, because all my money's in TSP and IRAs and whatever, or I would have charged it, which is also not ideal, right? So yeah, I love the product, love the process, and it's tough for people though, Dave, to, as an outsider looking in, to know how I can feel and you can feel and our families and our clients on what it feels like to begin to see how controlling the banking function is the way, right?
Yeah.
That's a tough thing. That's a tough thing to explain, because it's more than just the product and the process. It's a little bit more than that, right? You really gotta live it and want something different, want something better for the future.
Yeah. There are people that are hesitant. They get scared when it gets time to finally pull the trigger. You've had clients who get all the way to the end and they're like, I'm not quite, I don't know.
Yep.
It's because it's so out of the norm. So all I can say is, hey, just trust the process. You're not going to regret it. Go forward with it, and and look forward, not back. So,
I tell you, I was thinking about this. I wish it were, ethical and legal and I had the capital to be like, well, I'll buy your policies from you.
Yeah. Well,
I'll
the
fund
truth
them.
is-
You're just the
Yeah.
insured. But you obviously can't do that, right?
right. No, that wouldn't be ethical.
Don't have an insurable interest on them. But my gosh, Dave, they don't know what they're giving up. And I had that, I had that recently in November, December timeframe. Great, good people. Really liked them. Really thought it was gonna be great. And then but he was kind of all over the place and just didn't work out. But
Well, and they look at what they're giving up in the short term, the first handful of years,
sure.
and they can't look past that and see what they're giving up over the long term if they don't do it.
Yeah. They view their premium as a bill, Dave, which
Yeah.
is how I used to view my vanilla whole life that I used to own, right? Non-dividend paying. I just paid the premiums, whatever. Didn't leverage it, didn't do anything. It was the bill to me. And that's I think that's the change, folks, is when you sold me these first 4, I didn't look at those as a bill because I had read, I had educated, we had had a couple sessions. I can't wait to pay those premiums.
Yeah.
That's again, as an outsider, that's a weird, that's going to seem weird to people. Like, what? You want to pay your life insurance? No, I want to pay more often, more cash, more
Right.
premium. It's the solution, as James
Yeah.
would say.
Yep. Well, to wrap this up, take that image of that pyramid, and instead of viewing money going into each tier, tier 1, 2, 3, and 4 individually, picture all that money first going into tier 1, and then coming out of there and going into tier 2, 3, and 4, because that's what can be done. The sequence of your money. We did a whole episode on sequence matters.
Yep.
So you sequence it into tier 1 and then use that tier 1 capital to fund tier 2, 3, and 4.
That brings me to another last thought, Dave. Nelson talks about that in Becoming Your Own Banker. I'm holding it up for those of you listening, but on YouTube, I'm holding up his book because it's worth referring back to. Basically, paraphrase. He says, from here, meaning the banking system that you've created, the dividend paying whole life, you can do, really paraphrasing, whatever the heck you want to do.
Yeah.
Right? So just like Dave said, all the money goes there first. Your banking system, your policies, right, goes there first, and then from there you can do whatever you want without asking permission from anybody.
Right.
I don't know what that's worth, but it's worth a lot.
Yep. You heard it here first. So
what does he always say?
yeah, you heard it here first on roller derby or something.
Roller derby or something?
Yeah.
That's funny.
All right. Well, hey, that's a good one, and we'll leave it at that. So just, parting words, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.